I'm here today with Mark Palmer from Hamilton Court FX. We want to discuss the events unfolding with the ECB. What's your perspective on this, Mark?
Well, I think yesterday's rate cut was probably too little too late. And one of the trading guys here aptly said that Mario Draghi for the last year has been moving deck chairs around on the Titanic, whereas today there's no need to panic because he found a roll of duct tape, which kind of summarises the situation nicely in that it's just too little too late. An interest rate cut to encourage banks not to hoard cash is probably going to be effective, but then asset purchases maybe to €500 billion if they're lucky. Sounds like a big headline number, but when you've got to divide that across the whole euro area, just isn't going to be an effective tool.
What does this mean for Europe?
I think it means that Europe is just going to continue to limp on. Really, it will mean that the currency depreciates, comes low. We saw a big reaction in that yesterday, and although we'll probably get a bounce back as people take profit, it's likely that the euro will drag slightly lower. That will help. That will certainly make them more competitive to the global marketplace, but it isn't going to address structural issues that they've got, and the structural issues really come down to politics, and they're fairly limp-wristed politicians in Europe at the moment that haven't got the will to make the tough decisions that they need to make to get things sorted. So weaker euro, but probably little in the way of reversing the downward trend in growth.
What does this mean for the rest of the world?
I think the world is working at 2, maybe 3 speeds at the moment. You've got emerging markets that were obviously booming, that did slow down considerably. They might find themselves benefiting from this. The euro is now a very cheap funding currency, so you could borrow in euros very cheaply, invest in emerging markets, be that companies or sovereign bonds, and get a high return. So I think it's probably good news for emerging markets. I think developed markets, such as the US, the UK, I don't think it means too much for them. They may see some slightly increased competition from European manufacturers, and it will certainly mean that imports are cheaper as the euro continues to depreciate. But then for Europe itself, as the third sort of slow and declining speed economy on the world stage, it's not really likely to mean any near-term improvements, certainly. And if you do see improvements, you wouldn't expect them really until the middle to late stages of next year.